Hello, I'm Hunsley from Livewire Markets and welcome to The Pitch. Joining me today, Teiki Benveniste, the head of Ares Wealth Management Solutions in Australia. Teiki, for those who don't know, let's talk about credit markets and more specifically this dichotomy we see between private markets and public markets. So, to start with, what is the difference between private and public credit markets from that opportunity and risk perspective?
Yeah, it's a good question. I think first of all, maybe private markets may mean different things to different people. So there's a way to think about it, and the way we think about it is you put a delineation between, let's say, public instrument, public securities, and private instruments, credit instruments. So for example, you're going to have bonds are public securities and loans tend to be private instruments. So that's the first thing. Bonds tend to be, tradable. They have an active secondary market, so they have some level of liquidity. They are generally fixed rate, and most of the time they would be unsecured instruments. You go to the private side and the loan side. You have to look at that and say, okay, well, most loans are going to be senior secured. They're going to be floating rate. Then that's where you basically have to make a distinction inside the loan market between two very different markets. One is the syndicated loan market, where those loans are originated by banks. There's a big syndicate of lenders. There's an active secondary market. So there is liquidity just like in the bond market. And that's why at Ares we tend to group the syndicated loans and the bonds together in what we call liquid credit. The other part of the loan market, which we call direct lending, is where a loan is not originated by a bank, it's not syndicated, there's no active secondary market. It's originated by a direct lender like ourselves or a group of direct lenders. Generally that is still floating rate, senior secured, but it tends to have a higher yield because of the complexity and the liquidity. It tends to give you access to higher origination fees, so additional economics for investors. Those things are quite different in terms of what they are. So we would call that direct lending, and the rest we call it liquid credit.
Okay, got it. So now that you've explained that, why should an investor consider exposure to both private and public credit markets in today's environment?
I mean, all those asset classes have complementary characteristics. If you think about bonds, they have both duration and credit risk in them. If you think about loans, because they're floating rate, they have very little duration, but it's mostly credit risk. Some have liquidity, some don't have liquidity. So you can really look at all those asset classes at different points in time. They're going to show different value. So you can play the relative value between those asset classes, especially if you have a strategy that is nimble enough to do that. You can also structure strategies for investors depending on what they're trying to achieve. If you're looking at a strategy that's, for example, looking to extract the yield premium available in those more complex illiquid asset classes, you can do that, have a significant allocation to that, and still have allocation to some liquid credit to be able to offer liquidity windows, but also if the liquid markets dislocate, you can go in there and take advantage. You can have a strategy on the other hand that decides to go really higher up in quality, offer daily liquidity, have most of its investment in investment grade securities, and that will have a different return profile. They have less credit risk, lower returns, but also more liquidity. So it really depends on what you're trying to achieve with your strategy.
So let's pass this all together then. Tell us about 3 ways you're taking advantage of the global credit opportunity set at Ares.
Right now, we feel that floating rate senior secured instruments in those defensive companies that I've mentioned are probably the number one opportunity for us for our funds. So that's where we're going to have the biggest allocation. Then you look at, let's say, the alternative credit side of things. So where you have a debt that's backed not by a corporate but by a pool of assets. And we feel that there's very attractive opportunities in that space at the moment. One of those opportunities would be in the collateralized loan obligation market, You can find BBB rated loans that are giving you an extra 450 basis points over similarly rated corporate bonds. And then finally, there are still parts of the fixed rate market on the corporate side where we can find deeply discounted bonds, where we think there's maybe a catalyst for a repayment and a pull to par. But these are sort of smaller parts of our portfolios at the moment.
Okay, some excellent insights there. Teiki Benveniste, thank you for joining us there from Ares. And thank you for joining us for another episode of The Pitch. If you enjoyed the interview, you can subscribe to our YouTube channel as well as to the Livewire and Market Index websites. We'll see you next time.